I'm going to be going over a trade of the week for last week. Don't really have any stocks for the upcoming week to watch due to the volatility, everything that's going on with Greece and now China. I would expect some wild swings in the market. So don't want to say, you know, 4 stocks to watch over the next week when, any stock could pretty much have its major upswing or downswing. So let's begin. So going over Tesla from last week, then this could technically be a 2-day trade. It started on the 7th, and you could have gotten out on the 8th. Now, of course, the video will be sped up and it'll be fast forwarded through this because a 2-day trade could take an hour and a half, 2 hours, easy, with the on-demand platform. So let's begin. I already have the Tesla option chain pulled up and the Tesla chart. I already have all my studies. So now we are pretty much waiting for our entry. And alright, the MACD is crossed, but now we are going to wait for the candle to close below. Okay, the candle closed below, so we are going to get into the, let's see, I'll do the 275s. Alright, we're now in the position, and now we let the trade play out. Either we'll be getting out when 2 of the minute candles close above the 11-day moving average line, as I shouldn't say either. That is now our source to exit this trade. Okay, I'm going to fast forward this by an hour. Okay, and now it is 10:37 on the trading day. And let's see, you would have been stopped out on a 1-minute chart right here at around 9, let's see, well, I guess that one technically met. So I mean, this would have been, this little section right here would have been a, it could have forced you out of your position. As you can see, like right here, you may have gotten out between at like 9:44. But, and then at 9:45, it touched, then you would have gotten out here at 9:49. But shortly after that is when all the fun started. So real quick, let's look on a different time frame, see if it would have been the same outcome. Alright, so on a 5-minute chart, on the 5-minute chart, there we go. Okay, on a 5-minute chart, you would not have gotten out of this trade. You would see that the candles had met the 11-day moving average lines, and then they just sank below. So a 5-minute chart would have been more doable, and it wouldn't have caused you to get out of your position. Now let's look on a 15-minute chart. Yep, you don't even have any MACD signal to have gotten out of the trade. So I think it's safe to say that a 5-minute chart is better to hold your position rather than a 1-minute, because there's a lot more noise, if you could call it that. Alright, so we'll leave it on a 5-minute chart. Now the downside to a 5-minute chart is, say Tesla were to take off and start, going above this 11-day indicator that I have set up. Well, on the 5-minute chart, you're going to lose much, much more of this profit than, say, you would on a 1-minute chart. And part of the reason for that is the lines are much closer together on a 1-minute chart. So, perfect example to show this. See, on here, you would have probably, or you would be getting ready to get out of this trade. And that would be a $467.50 profit right here. But on the 5-minute, technically you should still be in this trade based off of this strategy. So that's gonna go up towards the 11, and your profit might end up being 300 to 350. Now, if it has some consolidation and it allows this line to get down further, then, which is what you would be wanting that on a 5-minute chart. That way your gains are then more so locked in. You have a higher lock-in rate, I guess you could call it. But again, I'll take note of that on a 5-minute chart, that if you base it off of this 11-day line, you are going to miss out on quite a bit more profit than you would if it was just the 1-minute chart. Okay, let's fast forward this again another hour. Alright, so now it is 11:53 on the trading day of July 7th. And you can see within that hour, profit has gone up another $220 on one contract. Okay. So let's jump this another hour. let it pre-buffer. Okay. Alright. So now, even on the 5-minute chart, I mean, you could have either stayed in this, or you could have taken your profit and let it go, which would have been at around 12:05. I mean, guess you could have stayed in here if you wanted, but then again, for sure, at 12:45. But this is over a 2-day time frame. So, how would you have been able to stay in this trade? Well, we know that the 1-minute chart would have sent you out of this trade very early. And now we know that the 5-minute chart would have put you out around 12:45. So let's see what the 15-minute chart shows. The 15-minute chart shows a touch at the 11-day moving average. So according to the strategy, you would still technically be in this trade. Now, a lot can happen in 15 minutes, so I really wouldn't so much rely on the 11-day as your stop. I mean, if you're losing profit, then take it. But for those that don't use any of the indicators or the oscillators, they may see this as, you know what, I'm going to let this ride. Then again, they probably have way more money, and they probably have way more experience. Again, this is pretty basic. So, with that being said, on a move like this, more than likely, you probably should have taken profit. But that doesn't mean that you couldn't get back in the trade. Of course, it would be at a lower strike. So in this case, you'd again be waiting for the MACD to give you your signal for the cross, and then maybe get in a 265 or a 262.50 put. Okay, so now we are going to go fast forward another hour. Alright, so another hour in, and there was a signal on the 5-minute chart, and you would have gotten on the either the 265 or the 267.50 puts. So you always want to try going for as close to in the money as you can. Try to avoid getting options out of the money, because then you're pretty much basing your play off a time decay, or what is known as theta. Also, too, figured throw in a little bit of Greeks here. Also, the more further out of the money you are, or in this case, let's say the further out of money you are, the delta which an easy way to explain delta is the possibility of the option going in the money. That's the easiest explanation for it. There's like 3 different ways to explain what delta is, but that's the basic. So pretty much an option out of the money might have a delta of, say, in this case it's a put, so a negative 30 or a negative 40. So you would see delta as negative 0.30 or negative 0.40. Now when it's at the money, it'll have a delta of 5 or 50. The further in the money you go, that is a delta of, say, anywhere between 60 and up to 1. And pretty much what that means is that is the probability of the option ending up in the money by expiration. It also is a way how you can determine, like, say, this is just as an example because I don't believe I can pull up delta on demand, but alright, say this 267.50 put, it would have a delta of probably around 60. So for every dollar that this stock goes down, it may gain 60 cents or $60. Now, one thing I am not too certain on about this is if that is based off of the next strike price or that is based off of just a dollar movement of the stock. I'll have to look that up. But that is another way, another example of what delta does. It will pretty much tell you that this is the amount that you will gain or lose if the stock goes with you or against your position. Now I talked a little bit about the theta. Theta is more so for the long-term traders. Say you buy a weekly on a Monday and plan on holding it on a Friday. Well, the theta is the rate at which the option decays. So, let's give an example. Let's see, use the 267 again. This might have a theta of, wait, this day was the 7th? Okay, Tuesday. So this, oh, dang it, there. So this might have a theta of, say, like 20 or 30. And what that means is, for every day that passes that you are holding on to this option, you will lose 20 or 30 cents, or $20 to $30. That's a way to explain theta. Again, it doesn't really affect the day trader so much, or the scalper, because you're in and out of the trade so fast. That more so affects the long-term options traders. Okay. So, position is up 607.50 right now, and I am going to go ahead, put this up another hour. Today we are nearing the end of the trading day. Alright, and it pretty much popped up here. So you would have gotten out of this trade. You should have gotten out of this trade, I should say. And then, I mean, you could have possibly rode this up, or it technically would be in power hour, which is the last hour of the trading day, which is also a spot where you will find stock movement. I mean, so you could have made some money on this little pop-up. Okay. So then let's go into the 8th. So let me set this to, I'll set this to 10. That way it's a half hour into the trading day. Alright. Now, you could have sold out and rebought in this position. Probably would have right here. Let's see, on a minute candle, the MACD shows that you would have gotten back in this trade. I guess you could have gotten in it on the open, although that's not really recommended. You typically will wait the first 10 to 15 minutes of a trading day unless you see a good move, or you have the experience to know that within those first 10-15 minutes of this trading day that very easily the stock can switch against you very fast. Which in this case, which is exactly what kind of happened. Like it took off, or it fell, and then it took off, and then it fell again. But if anything, based off of this, your signal to get into this trade, based off a 1 minute candle, would have been at 10:01. Now, if you would have held this position, you would be up $1,345 because there was a huge gap down during pre-market. $265.23 down to pretty much $259.94. Okay, let's go ahead and put this back on the 5-minute chart. And just to give of why there are no stocks on watch this week, this is exactly, or one of the reasons why. Okay, the volatility is getting much higher than normal. In the summer months, you may hear, investors and traders say that this is the slow time of year. That's typically how it is. But now if we look at the VIX, I mean, it's trading at 18. That's not really all that common for this time of year. And the whole reason why there's all this crazy volatility going on is because of the whole Greece and now China. So you can't really, the whole weekly alert, it's for long-term, I guess a week you could consider it long-term, but it's for trends. When you have a volatile market like this, you can't really rely on a trend because the markets will be all over the place. In this case, like if we were to look, let's go a little further back. Let's say 180 day. Okay. Now if we were to look at this, I mean, see yeah, it's Tesla, so it is a little bit more volatile than most, but you still have this trend. You have a trend that it follows over the long term. I mean, I could even probably do it over a 20-day. Yeah. It has this trend. And now when we got into this crazy volatility with Greece and now China, I mean, look, it just took right off, and now it's fallen, what, 10, 20, almost 30 points within a period of, what, 4 days? 3 days? 1, 2... Yeah, within a period of 3 days, it fell almost 30 points. So, that's why I'm not doing any stocks to watch for this week. I mean, what you pretty much could do is look for the IV rating, which is the implied volatility rating on a stock. If it's over 50%, you should be able to catch a swing on that stock. Okay. So put this back on the 5-minute. And since that explanation, we lost maybe $30. But now looking at profit of $1,420. Okay. So let's put this up another hour. Oh, didn't do it. There we go. Alright, so this, again, the stock, and this is on a 5-minute chart. The stock took off. You probably would have gotten out here. And that would have probably set you around, I want to say, between 1,100 and 1,200 for a gain, which that isn't bad. If you got out of the trade and got back in, let's see. You would have, let's get an idea of what you would have made. First off, you would have gotten out. Let's see, if you did this based off of a 1-minute chart, which you're looking at this, I'm kind of leaning out of the 1-minute chart. A 5-minute chart seems to do better justice. But with that being said, okay, you would have gotten in the position probably here, or you may have gotten on it at the open. Let's say you got a 257.50 put. Alright. So I'm going to put this back to 10.35 just to get an idea of what a day trader that did not hold this trade would have gotten. Okay, so 11:35 or 10:35. I apologize. 10:35. Okay. So that would have been, say, probably around a $200 to $300 gain, roughly. Probably more so toward the $200 side. But yeah, so you still could have made profit on that little move, if you did not hold the position. Alright. So let's bump this up now to 12.37. Alright. So it popped up and then it started falling back down. Okay. Gain of 212 or 12.50. Let's take this up another hour. And it slowly started creeping back up. And let's do this another hour. And it fell again. And we'd be sitting at a gain of 13.20. Alright, so now let's put this on the last 10 minutes of the trading day. This is just fast forwarding an hour and 10 minutes. Okay. So we could have made some pretty decent profit over a 2-day time frame. We look at when we bought this position, we had bought it at 6:30. One contract, and now it is trading at 1980. So that is let's see, 6:30. So 1260, 18, 19, 20. So this is over 200% gain. And that is more than impressive. And that, again, that was only one contract. So, I mean, 2 contracts, you double that. That'd be 2,810. But again, base your trade off of your account balance, risk management. You know, if you think the trade is going against you, take your profit. Don't sit and hold. This said Tesla has had some. It has some pretty crazy swings, so it is something to be careful of, at least when you're trading Tesla and trading with a few other stocks during this time of heightened volatility. That is it for today's episode of Dissect the Trade. Let me just go ahead and sell that order. Within the next couple episodes, I hope to have on a special guest. We're just working out the technicals with how we can be able to do this. Getting the time, the time where we both can. So that is something to be interested in. Look forward to. He is a very, very knowledgeable trader, and I am really excited to hear to hear his background, how he got into trading, and his process for how he starts these positions or how he spots them. So, that being said, be careful next week. Hope you guys have a good week in the markets, and hope a lot of you make money. And with that being said, until next time.